In today's video, I'm going to go over an old example of timing work to help you understand the next example of timing work. Okay, so I'm going to start with a daily S&P cash chart, and I basically measure in time some of these prior swings in the market because it gives you a heads up for potential turns besides just running the price work. Okay, so you have the whole added dimension as far as trading is concerned. Now, as far as the last standout timing that I had for a possible low, it came in between 9.5 and 9.7. And there were quite a few cycles that were in play at that time. For example, we had this prior high to low that was 6 trading days. This was 6 trading days. And then we had 6 trading days into the low made on the 7th. So that's one thing. There are also some other cycles. For example, a low to low from another low. Well, actually that came in on September 4th, so that was a little bit on the outside. But then we had another low to low cycle, September 6th, and another low to low cycle, September 5th. All right, and then where did we have actually the 7th? Oh, here it is. The 7th came from taking the prior high to low swing here and then projecting 100% of that from the new high. So that's where you had September 7th. This is another one of the same, 6 down compared to that declining swing. Bottom line, we had a bunch of cycles between the 5th through the 7th, and we were anticipating a possible low because the market was pulling back into support at that time. So we made a low, we saw buy signals against it. After the initial bounce that we got, it got a little bit scary. It looked like it was going to maybe take out that low, but it ended up holding. And you've had a rally of over 76 points in the S&P. So that's how it's supposed to work. Now that doesn't mean that it's going to work the same way this time. However, I've got to show you that I have a timing histogram that tells me that we have time resistance to the current rally. I have the outright cycles. I've got the 21st, 20th, 21st, and 21st. So we're right on top of those. But also, even if we haven't made a high yet, there's another cluster of cycles that comes in early next week. Well, starting with the 24th. So then it's going to be the 24th, 27th after that. And you can see that I have quite a few cycles there also. So when the market is trading higher into a cluster of cycles, you want to anticipate a possible pullback. And let me show you one more thing. As far as the S&P futures, check this out. This prior rally swing was 10 trading days. Today's high was made 10 trading days up. That's where some of that resistance comes from. We had another swing that was 11 up, another one that was 13 up, another that was 12 up, another that's 10 up. Okay, now there's a lot of swings that are similar. And in the past, okay, when you had this 10 up, you had a pullback. 12 up, you had a pullback. 13 up, you had a pullback. 11 up, pullback. You know where I'm going with this. This was the last time you had 10 up. So does this mean that we're definitely going to roll over and get a decent pullback? No, but it's the time to anticipate that possibility and be prepared to, number one, exit long positions if you're in the S&P. And number two, only if you're nimble, you can look at the other side of it. Okay? Because a lot of times these counter trades don't last very long. And they're not actually the best ones to look at anyway, but yeah, that's what I have in timing. So I hope that explanation helped a little bit as far as why I would be looking at a pullback now, besides the fact that we did make the initial target off of this last low.